Hi guys and welcome back to the My Investor Show. Today I want to walk you through three stocks that are down significantly from their all-time highs earlier this year, and I'm buying them for the month of August. But before we get into the stock, I want to go through some market-wide data. Firstly, the US labor market. The US employment growth has been slowing significantly, and this matters because of one man, Jerome Powell, who based on these data points has been leading the fiscal policy of the United States. Lower employment growth means companies are not investing as much to create jobs in both the private and public sectors. This leads to higher unemployment, which means fewer people working, fewer people consuming, and a slower economy. If this slowdown continues, it might push Powell to cut rates faster than expected. Until now, he resisted pressure to cut because the labor market was solid. But the latest payroll data has pulled the rug from under him. Now the market expects 2 to 3 cuts by the end of 2025. And I think this is good for the economy because it will likely boost the stock market overall. The second thing is the tariff situation. While tariffs aren't in the headlines as much as they were in April when Trump announced massive tariffs and the market dropped 20%, the underlying data tells a different story. Looking at the August 1st tariff map, some countries like Canada, India, Brazil are now facing much higher tariffs than they were in April 2nd. I think this represents both the geographical shift in where the tariffs are applied, but also shows how things can change very fast depending on how Trump sees the situation, who is in favor of Trump, who goes with the waters of Trump. But the situation is still very uncertain because those policies can change suddenly depending on the US, on Trump's position, and we haven't yet fully seen the impact on companies' income statements yet. So I think with a combined weaker job growth and higher unemployment, this uncertainty could impact consumer spending directly or indirectly, and with the tariff situation further impacting the cost pressures for the different companies. I think this is still a situation that is very much uncertain, that is leading stocks lower for some of the companies that even I'm going to speak about today. So this takes me to stock number one, Deckers Corporation, ticker symbol DEC. 2 weeks ago, Deckers reported Q1 results and they absolutely smashed it. But year to date, the company is suffering. Year to date, the company is down 50% from its all-time high. I entered the stock, I invested in the stock at the $101 level, and I will continue to add if the stock price falls further. Essentially, what happened with Deckers, which I'll cover on a very deep level in a few minutes, but essentially what happened is that 2 weeks ago they reported Q1 earnings for 2026 and they absolutely smashed it. They double beat on earnings and revenue. The stock jumped 20% after hours, but then it came back down to $103 a share. And Deckers owns two brands that you probably heard of, and that's Hoka and UGG. In fact, the company has been growing at a very attractive CAGR in terms of total revenues. As you guys see, since 2012, the company has been growing steadily and consistently, and the company is mainly consisted of UGG and Hoka. They also have some other brands wholesale, some of which fall under the Deckers umbrella, but that's a very insignificant amount. It's just 4% of revenues. So most of their revenues comes from those two very strong brands. So why did the stock fall 50%? If revenue is growing, if earnings are growing, then why did it drop? Well, investor fear, that's what drove the stock down 50%, which created a massive opportunity for me to enter. Number one was the tariff related cost pressures. The company has very heavy reliance on Vietnam sourcing, and they said that they expect 150 million in extra costs, which are raising margin concerns. They have also said that they expect a slowdown in direct to consumer demand for Hoka due to weaker consumer sentiment, and they gave a soft 2026 guidance. They gave mid-teen growth for Hoka, mid-single digits for UGG, plus macro weakness waiting on discretionary spending. And I want you guys to remember those numbers, that guidance, because when we look at the Q1 earnings, you're going to be extremely surprised. My take is that I believe that the leadership is deliberately downplaying expectations to, number one, beat them later, which is exactly what they did in the first quarter of 2026. And secondly, to buy back stock at lower prices under their very large buyback program. They have a buyback program of 2.5 billion, and it's better for them if they buy the stock at prices that make sense, at prices that are very attractive for them to buy it as well. So for them, this situation is ideal because they're buying back stock at very low prices. They are returning value to the shareholders. And in the meantime, they're double beating expectations year on year. So the first quarter 2026 results were the following. Hoka grew 20% year on year. UGG grew 19% year on year. And while other brands were down 19% as well, it's mostly insignificant because the other brands are, as we said, only 4% of the business. The company also has a very strong cash position and has no debt. It has no debt, I repeat. It's growing at exceptional levels and has no debt. And the CEO said that Hoka and UGG outperformed the first quarter expectations with robust growth, delivering solid results. And though uncertainty remains elevated, our brands have not changed and the long-term opportunities are significant. So overall, it was an A-star results quarter. In fact, I could argue that Hoka alone could justify the company's valuation. In fact, Hoka since 2019 has grown revenue 8 times. I'll repeat, since 2019, the Hoka brand itself, just the Hoka brand itself, is now bringing revenue 8 times more than they used to 6 years ago, and is compounding at 42%. This is faster than some high growth tech names like Palantir. And remember, guys, this is a company that trades at a P ratio of 15. For me, this is insane. I don't understand what the investors are missing, what Wall Street is missing that we are not. But this is an enormous opportunity. In terms of valuation, in terms of my base case, for my base case, I have assumed 8% revenue growth, 10% EPS growth, and 11% free cash flow growth. And with a 50% of margin of safety, my intrinsic value for the stock with margin of safety is around $109 per share. And this is a no-brainer for me. I have bought stock. I'll continue to buy more stock. And I do think that this company is very, very well positioned to succeed in the future with a price target of 250 to 300 by 2030. The second stock I wanted to cover is none other than United Health Group, UNH. United Health has been crushed. It feels like a falling knife all the time, but I still believe in the company's long-term potential. And I have invested in this stock at 283 USD. Since it has fallen more than 50% from its all-time highs. The former CEO, Andrew Whitty, resigned earlier this year due to personal reasons, and the company brought back Stephen Hemsley, who, once he joined the company, acquired 25 million stock in May, as you guys can see from the insiders buys and sells. Insiders have been buying very heavily over the past 2 months. Stephen Hemsley is no stranger to the company. He was the CEO between 2006 and 2017. During his tenure, the stock appreciated 7 to 8 times, and the company expanded through significant growth and expansion, including the diversification of its health services and technology capabilities through its Optum subsidiary. He was widely credited with driving operational efficiency and helping position the company as a dominant player in the healthcare landscape. So he has a track record, he has the operational efficiency, and I do think he will change things around because this is exactly what we need. We need a company that is very strong operationally to improve margins. However, the company reported Q2 earnings last week, and I'm gonna be honest, guys, they weren't great. Revenue grew 13% year on year and beat estimate, which was a good result, but EPS was down 40% year on year and it missed estimates by 8%. And I do think that this shows how much the company has suffered from cost pressures. In fact, having listened to the earnings call, there's some cost headwinds that are deeply affecting the company. The company is facing multiple fronts at the same time, and cost pressures are piling and piling and piling. In fact, they said that pricing assumptions were well short of actual medical costs. The review for 2025 reflects 6.5 billion more in medical costs than anticipated in the initial outlook. In terms of V28, the V28 is a new formula, for those that don't know, that the government uses to calculate how much insurers like UNH get paid to cover Medicare Advantage patients. And UNH is facing 11 billion, that's billion with a B, in costs over 3 years, 2 billion higher than originally expected, and 7 billion of which will hit through 2025. So margins will remain low, below the 3% level, and will return to higher margins, potentially 5 plus or 4 plus at least, from 2027 onwards. They're also seeing increased in-care activity across individual and group Medicare Advantage, which will continue through the year, which again impacts margins, and they also have settlements up to 500 million. So overall, as you guys can tell, the company is facing so many cost pressures from so many fronts, and at least the leadership is being transparent about it. They understand the problems, and they're trying to fix so many operational mismatches that happened over the last 2 years. The positives from the Q2 results were that firstly, they will add 300 new value-based care patients. Of course, this is down from the previous 650,000 that they said, but essentially what they have said is that they are focusing on high margin areas. They're trying to limit revenue growth and mostly focus on the operations, mostly focus on improving margins rather than grow at the levels that are not sufficient enough to improve the margin, which I think is the right approach to do. They also expect 1 billion in cost reductions in 2026 through a pricing discipline, better forecasting, and operational improvement aspect. And they are accelerating investments in consumer experience and core modernizations, with investments in AI to be realized by 2027. In terms of the intrinsic valuation of the business with margin of safety, my base case is that the company will grow at a level of 10 to 11% for revenue, EPS, and free cash flow. However, I want to tell you that I have already included a 2025 impact, so all the growth estimates are from 2026 onwards, which I think are very conservative and base case scenario, because with those growth estimates, it means that the company will return at 2023 levels in terms of net income at around 2030. And with a discount rate of 10% and margin of safety of 50%, my average intrinsic value with margin of safety is $205. And I do think that the 2030 price target will be roughly around 500 to 700 USD. But of course, it all depends on the leadership and management executing on what they said they will execute. The third and final stock that I'm covering for today is LVMH, which is down 50% from all-time highs. The stock was trading at 900 euro back in 2023, and it is now trading at roughly 260 euro. And I have been buying over the last weeks at an average price point of 452 euro per share. And this is a company that has been growing steadily over the last decade. Unfortunately, over the last 2-3 years, they have had an impact in that growth. They have seen lower demand for their products, which consequently has affected the share price of the company. But they have not only seen falling sales for the last 2 years, but they have also seen declining margins. And the CFO is claiming that this is mainly due to macro uncertainties and currency swings. But I think there is more going on, and I'm going to touch on this in just a second. Before we do, I want to show you the Q2 results for 2025, which were really bad. They underperformed, they missed on sales, they missed on profit. In fact, revenue for the first half of 2025 was down 3% or 4% on a reported basis to 40 billion. Profit was down 15% year on year to 9 billion. Their biggest business segment, fashion and leather goods, was down 8% and was 19 billion. And regionally, they said they're seeing more demand locally in the EU and the US, while Japan is also down. They said that in an uncertain geopolitical and economic environment, they remain confident in maintaining a strategy focused on continuously enhancing the durability of its brands, drawing on the exceptional quality of its products and excellence in retail. So overall, the company results were not great. The company itself is looking more of the long term rather than the short term. They understand the problems that they're facing, lower consumer demand for their products, but at the same time, I think there's some positives to be taken out from the company that we'll talk through in a bit. There are also some parts of the business that are performing well. For example, perfumes and cosmetics, which are mostly targeting mass market consumers, are relatively performing well compared to other product lines. Watches and jewelry as well, which focus on the more high-end, the luxury consumer, are also performing quite well. And selective retailing like Sephora shows that the omni-channel experience is also performing quite well. But why is this not a pricing issue? Why can just LVMH raise prices and simply pass on inflation and tariff costs into the consumer? Well, it's because LVMH is not the luxury or a mass market conglomerate. It's actually both. LVMH has 75 different brands, and it has all kinds of brands across the mass market and luxury market value chain. Premium consumers, for example, are price inelastic. Those are the types of consumers that if brands were to raise prices, like Hermes, for example, they would be okay absorbing it because inflation and tariffs are not impacting their disposable income, because their disposable income is at the 1% highest of the world. And that's the top right of this chart right here. In the contrary, if you have mass market consumers, which are price sensitive or price elastic, it means that with a higher pricing strategy, you're probably going to see less demand. And the mix that LVMH has makes pricing strategy a balancing act. Unlike Hermes, LVMH cannot raise prices that freely. They have to justify raising prices. And so it's much more difficult for LVMH to pass on that extra cost, that margin cost into the consumer, whereas Hermes, for example, which is performing much better, is able to pass down that premium to the consumer. But with that being said, I think there's some 4 key areas, key points why LVMH is very well positioned to return to where it has been. Firstly, it has premium positioning, which would drive growth post 2025. And in fact, analysts also expect growth in 2026. Secondly, insiders are buying, which shows strong belief in the brand. The Arnault family has 50% of the company, yet they still bought stocks this year in April. Thirdly, they have the strongest wide brand and product diversification in the luxury market. There's only one LVMH. I cannot find another comparable like LVMH to compare it with. And fourthly, it has the lowest price to sales, price to EBITDA, price to earnings ratio since the COVID-19 crash, and 13 billion in cash ready to deploy to expand the business organically or inorganically by acquiring another. So I do think that the company is well positioned to rebound. In terms of the intrinsic value of the business, my base case is that the company will grow at a 6 to 9% level post 2026. I have also already estimated the 2025 impact, and with the margin of safety of 50% and discount rate of 8%, my average intrinsic value of the business is 362 euro, and my 2030 price target for the company is 900 to 1,100 euro per share. So these are the 3 stocks I'm buying: Deckers, United Health, LVMH for August, which are well below historical highs. They're facing short-term headwinds and they're leaders in their respective markets. I'm building the positions now, but I'm keeping cash ready to add if prices drop further. Shout out to everyone who has donated. If you want to donate, use the link below. Even the smallest amount goes a very long way, and I'll sure shout you out next video. Follow me on X for daily updates and subscribe if you enjoy the content. Thank you so much and see you in the next one.